Welcome back to Market on Close. I'm Sam Bartas on the floor of the New York Stock Exchange, and joining me here on the trading floor is Dory Wiley, the CEO of Commerce Street Holding. Dory, thanks so much for your time and joining us here and coming up to the cold weather. I'm just wondering, what you're thinking about with respect to these markets, because we just continue to see this sort of internal tension and this churn under the surface, while we're only just a couple of percentage points still off the highs of the S&P 500. So is this rotation healthy, do you think?
That's really the question that I have too. It does seem, on the surface, it seems healthy because everyone thought there's too much in tech, too much market cap in tech, Mag 7's too big, they're too overvalued, and we get this sector rotation. But it seems a little backwards in some ways. While some of these stocks like banks and others, they should be higher, it doesn't necessarily mean that tech should be lower, particularly some of the Mag 7 like Nvidia, who really aren't part of this AI SaaS problem. And then you see all this underlying volatility, which I call kind of tremors, and do they warn us about something ominous to come? So I think it's good to have a little yellow light on right now.
Okay, something worrying. I'm just wondering how you're thinking about some of these companies as far as the CapEx and the numbers they're throwing out there. I mean, tapping the debt markets to fuel some of this, and also what we're seeing as far as the conversations even today around private credit.
Yes, absolutely. And we're seeing deterioration in private credit versus the banks. The bank's credit box has gotten tighter since 08 with Dodd-Frank. And it's very clean. It's very good. It's been very strong. And it was, COVID was a great test for that. Mm-hmm. The office space wreckage was a great test for that. And so while banks have, say, 36% of the office space, there's a higher default rate in the private credit sector, say in CMBS that we're seeing, and in delinquencies, than what we're seeing in banks. And I expect that across all sectors in private equity. But the real question is how much, and we really don't know. We saw some deterioration or at least concerns from Blue Owl today.
That's right.
With the big sell-off, and that's making the market nervous, and I think the market should be nervous about that.
It's bringing us back to sort of the cockroaches type analogy that it was Jamie Dimon who made that comment at the back end of last year, right? I'm just wondering, as far as these earnings, because it's been a very sort of earnings-driven type of day with some of these big double-digit percentage gains and losses that we've seen in the market, and it's confusing because we've seen beats that have been punished and misses that have been celebrated and rewarded. Nvidia is obviously going to be our big one next week. What can we expect to hear from Nvidia, given the bifurcation we've seen in technology in the last few months and just what we're hearing from the hyperscalers?
Yeah, I think that's a very good question. I kind of say Nvidia is the center of the universe, and
everyone's in
Meta proved that yesterday, right?
Yes.
We want all your chips, and they're into everything. And as Nvidia goes, it's going to be very important for the rest of the market. They have a track record of a good beat, and even so, they're running 50% margin and 100% return on equity and a fantastic growth rate. They do trade about 35 to 40% below their 3-year forward PE. And 40 to 45% below their 5-year forward PE. I think a good beat on that stock could set the tone for a longer term rally for them, because they shouldn't be drugged down, which I think they have been a little bit by this AI SaaS issue. And even though they've fallen the least amount of the Mag 7, if you go back and look how they performed for the last 6 to 7 months, the stock hasn't done anything but drifted downward, while their fundamentals are fantastic.
Okay, let's drift down market cap now and just talk about, obviously some of the other areas of the market which have been catching a bid this year. I mean, off a bit this week, but the financials have been doing pretty well. I was having a good chat to somebody this morning about the regional banks as well. I mean, these have been hitting a record this year on a lot of the benefits coming from the rotation, also that steepening yield curve as well, not to mention everything else that's going on with the regulatory environment and M&A. Do you like that space?
Yeah, we do. Our firm at Commerce Street is very active in the bank space, and we invest in banks as well. Banks have been a fear trade since 08. And what was interesting since year end is they've really rallied and done very well, or at least since November. even with the AI SaaS issue and fear in the market and the trembling, they'd done really well till last week, which kind of concerned me. There's nothing fundamentally wrong with these community banks, regional banks, or even the money centers. So I'm kind of wondering where that fear is showing up, because it should have been there, prior to that. But the banks are doing great. They have record levels of capital. Their margins are expanding, because rates have been kind of stable. They're not a 500 basis rate shock up or down. And the credit underwriting has been very, very good. And so I think banks are a great place to be right now. There's no reason why they shouldn't be trading 15 to 18 times earnings.
Okay.
Versus, 9 to 11 in the micro caps, small caps, or 10 to 12 in some of the bigger small cap, mid caps.
Talk to us about some of the names that are on your radar, because you've been looking at those who might be the ones on the acquisitive side in the M&A.
Yeah, M&A is extremely hot right now. We had deals that were tied up with regulators for 2 and 3 years at a time. And now with the change in administration, change in leadership, a lot more focus by the regulators, deals are getting approved in 60 to 90 days. And it's giving confidence to the buyers to go out and say, hey, we can do this, and not tie up ourselves in a strategy and be lost for a couple of years. So it's been more active the last 2 years than the previous 4 to 5 years combined. It's very, very busy. So, Huntington was a client of ours that we represented in helping to acquire Veritex in Texas. They went and acquired Cadence after that. You saw Fifth Third by Comerica. It's very active. So that will continue, and we suspect it will. Huntington, if you look at their core deposit growth to their peers, it's higher than others. With this aggressive acquisitions, aggressive disciplined pricing acquisition strategy, I think will pay off for them, in addition to their organic growth in these new southern markets that they're pursuing. And you can still buy that stock at 10.5 forward PE, and you get a 3.5% yield on the dividend.
Right, relatively
a micro cap name that we're a big investor in is Third Coast in Texas, TCBX. That stock is also 10.5 dividend, but it has a crazy growth rate, and it's the fastest growing tangible book value per share stock that I've been in 20 years.
Okay, so a few names to look at. It's all about that discipline, isn't it? Hey, look, Dory, we have to wrap it up there. We've completely run out of time, but thanks so much for joining me on the floor today. Really appreciate it. All right, there's Dory Wiley there, CEO of Commerce Street Holdings.